A nickel bid at $10. That was the bid to offer that I was seeing in an options trade today. We ended up trading these contracts anyway. I'm going to talk to you a little bit about how you do it today on Open Interest. Hello, everybody. Welcome. I'm Mike Coe. Welcome to Open Mic. If you can see my screen, we'll pull this up. This section right here is a structure in, let's see, this is Freedom Holding Corp. Selling a 140, 170 strangle right here. And buying a 180 call to hedge the upside risk so there's not some unlimited risk. Now, if you can, observe the markets. The mid-market on the 170s and the 180s is the same. In fact, actually, I bet it's the same for a host of strikes. Let's just randomly, I'm going to put that up to 200. It's probably pretty close. 200s, no bid at 480. Everything was no bid at 480. 170 calls, 175s, 80s, 85s, 90s, all the way up to the 200s. The 140 puts were nickel bid at 5. If you put this trade in at the market, you might have sold the 140s and the 170s at a nickel each, a dime, and ended up buying these at 480, a 470 debit on something that is a guaranteed loser. The best thing that could happen to you if you did that trade at the market price would have been a $470 loss per spread. And yet we did trade this, and we collected a net credit in this neighborhood here, which is a nearly 50% annualized return over here. Obviously, you're taking the risk. You could be put the stock at 140 over the course of the next couple of weeks, or you could be called out of the stock at 170. So how do we go about doing something like that? How do you establish what a fair price is? Do you simply take the mid prices? Well, that wouldn't make much sense because the mid price on the 170s is 240, and the mid price on the 200s is also 240. So obviously, the 170 calls have to be worth more than, well, the same amount or more than the 200s are. So if you had sold this, let's just say for the sake of argument, ignoring the long leg, you had decided, okay, well, I'm going to sell this strangle at $4.90 or so. That would have been substantially higher than this limit price you see here. Would that have been a good fill? It would have been an exceptionally good fill. And how did I arrive at that conclusion? Well, here's the thing. So we're going to take a look at FRHC. And we're going to take a look at what the implied volatility for FHRC is. And what we can see here is that the 1 month implied volatility, we're going to get rid of the historical vol. There was a spike recently. That was the reason that that was actually on the radar. Is, between 50 and 55. So with that information, we can then plug that volatility into, at the very least, a July 17th strangle. And we'll do that. And I'm going to say, we'll call it a 52 vol. And oops, I screwed that up. So let me do that again. I put it into the forward. That is wrong, of course. I was trying to put it into the field below. So hang on a second. In my haste, a little keystroke error there. Let's do that again. So again, 0717, 17 expiration. That's the one we're looking at. I'm doing this on a Bloomberg terminal. There are other ways to do this. This is what I want to do. 52 vol. 52 vol. 140 put, I guess. Stock is in a slightly different place. And what do we have here? The 170, 180 calls, something like that. Okay. So here we go. Stock price slightly different, but as you can see here, we thought the mid-market volatility, fair vol was about 52. We traded this thing at 340, so let's try 51. 51. There it is. So we sold, and actually that was 340 with the hedge leg. So we actually bought an upside hedge leg, but just the strangle at 51 vol, which is just below the midpoint of the implied volatility going out 1 month, is about $3.40. If you added another leg, and we did add another leg. In fact, we paid a dime for it. So actually, what we can sort of figure out there is that's probably 51 and a half. 51 and a half gets us to 351. There you go. So essentially, traded the package at 51 and a half vol, and then paid a dime to hedge the upside. So this goes to what we were talking about before, and on Monday. So on Monday, there were these questions, how do you interact? How do institutions interact with the market? How do we make a price on securities even when there's none visible? And are things tradable even when the markets are exceptionally wide? And the answer to that is you price things up on a vol basis, and then you basically dip your toe in the water and try to figure out where people would pay you for it. Now, you're not going to go out and negotiate with institutions yourselves, but as FinWest pointed out quite rightly, and I think a couple others did too, and let me just pull up the social media chat because I forgot to do that. You can essentially test the water, and you can do that by working limit orders at some attractive price. And in this case, you probably would have started out somewhere in the middle, 485-ish or so. Looks like that was 480 was maybe the middle of the market, and then sort of worked your way down. And basically what happened was I just went out soliciting bids. I saw a 340 bid, and then I looked at the vol and said, okay, well, looks like it should be about a 52 vol. Where does that get me? That's, $3.50 in the strangle, plus I got the other leg to do, so that's a fair price. To put things in perspective, it was considerably better than the next best bid I got. So the next best bid I got was like 261. Again, you're not out there negotiating, but here's the thing: the way retail interacts with the market is like the difference, and an institution does it, is that it's as if an institution is going around to every car dealer anywhere nearby and saying, here's what I want, what's the price, haggling. Next car dealer, here's what I want, price, haggling, on and on and on and on. Whereas if you decide that you're going to start on the offer and work your way down if you're a seller, or start on the bid and work your way up if you're a buyer, as a retail, you're actually kind of negotiating in more, with TrueCar, basically. You're not sort of dealing with them directly and chatting back and forth, but TrueCar can get you a better price on a car. At least it seems to have been able to in those instances where I used it. And I think this is just an important thing to think about. Now, if you are going to trade options in markets as wide as this one is, it wouldn't be my first choice. I would not go out and say, oh, gee, maybe I can go find some really nice wide markets and see what happens. That's not really the way to do it. But there will be circumstances where you have a view on an underlying security, an underlying asset. It could be a commodity, it could be a stock, it could be an ETF, it could be an index, and maybe you want to trade options on that, and then you go and you look and you see markets that look like this, which is to say almost no market at all. And then you're going to have to go out and try to figure out, what's a reasonable price for this? And actually, you know, I'm kind of curious. You know, if I went into, say, options play, I didn't use that. This is, you know, an internal system that we have. And actually what it's, one of the things that this is designed to do is to, you know, figure out, you know, where the vol itself should be. You know, what's a reasonable volatility to use for some of these things. I'm going to delete this strategy so we can get a sense of it. This is actually configured in such a way right now that it's just pre-populating that strategy as a package. Sell strangle, buy an upside call hedge, try to identify a cheap call to buy that basically caps the risk. Willing to sell a put and willing to get long the stock, willing to sell a call, willing to get short the stock, looking to collect a little bit of insurance money, and then automatically calculate the APR. So that's all this is intended to do. But the real exercise here is, you know, smoothing out the volatilities so that you actually can say, okay, I can see what the lit bid and offer are for any respective options, but I can also kind of establish where I think I might be inclined to bid and offer based on the volatility. So there's a couple different approaches that are being used in this case, where there are some smooth volatilities that are being developed, like a smooth vol surface for the bid and a smooth vol surface for the offer. And, you know, depending on which technique you use to smooth it, we have this theoretical smooth and we have an interpolated one, where it's basically just trying to draw some lines through points that we know are good. And in this way, we're comparing the prices that we see in the marketplace to what we think are actually reasonable. In other words, if we were a market maker, where would we be willing to buy? If we were a market maker, where would we be willing to sell? And then comparing that to what's available in the marketplace. And usually, in a name like NVIDIA, as you can see, not really make any difference, right? So the lit bid was 70 cents. Theoretically, 71 cents. Interpolated, 70 cents. Interpolated ask, 73 cents. Theoretical ask, 73 cents. And the actual ask was 73 cents. So you can see that, you know, really actively traded single stock options and ETF options, you know, that have tight bid-ask spreads, you're not going to see much of a problem. This kind of more complicated stuff is the kind of thing you need to do when there isn't really any price. You kind of have to figure out for yourself, well, what's a reasonable price for an option? And, you know, this is where I think an interesting element creeps in. And I've shown this chart before. I actually was asking producer Jay, I was like, how often do I actually show? Let me just get rid of my pad for a second. I'm sorry. Some things that we... Okay. Let's make sure I don't accidentally show the trading pad while we're at this. How often do I show this chart? And the reason I bring that up is because when you are trading options, whether you're buying them or selling them, if you are not hedging the change in delta, that is to say hedging your gamma in these options as you go, this is really the way you can kind of think about what the value of an option is, what its expected value will be. You take a look at where the stock is now, you take a look at the value of the options, and you take a look at how much the stock moves around in general, and you handicap what you think the likelihood is that it's going to exceed some value. In this case, these price returns are measured in percentages, and this is going out over one day. In fact, we are, in the case of Freedom Holding, we're actually looking at a period that goes until the expiration of that option, which is the 17th. Today is the 1st, right? Today's the 1st? Yeah, today's the 1st. I should know that. Saturday is the 4th. So we really have effectively, we'll call it 11 trading days, 12 trading days remaining. No more holidays other than that. So as we take a look at this, and there are a bunch of different ways you can probably get this kind of data, but really what you're trying to figure out is, okay, what is the likelihood that it's going to move by a certain percentage between now and that date? This is going back a year. If I go back more than a year, let's go back, I don't know, let's go back 3 years, right? So this thing's at 157, 170 calls are 8.3% higher. The 130 puts are, well, that's 17.5% lower. And so, I can see that the chances that it drops below in a random sample, the chances that it's going to drop 17.5% is exceptionally low. The chances that it goes up more than 8.33%, that's going to be this region over here in general. So why then did the portfolio manager in this instance decide that they were willing to sort of sell off some of that upside? And the reason was because of this. So if you look up here, what happened to the stock? The stock just moved $26, almost $27 today. So while these kinds of moves do happen, where you get these big upside moves over periods like this, the logic is that in this case, this move has happened. In other words, if a big move is going to happen to the upside and it just gapped to some new level, what is the likelihood over the course of the next 2 weeks that it does the same thing again? And in the portfolio manager's case, where we're talking about this trade, the estimation is that the move, having happened, has repriced the stock appropriately, or near enough. I mean, we're talking about a gap, we're talking about a 25% range that has been selected here. So saying, okay, this thing just made a huge move. I don't think it's going to go above this, and I don't think it's going to go below that. What's the likelihood over the course of this period of time, this is the region, that it's actually going to fall below this level from whence it came? And it's going to get, back to or through the level from whence it previously fell. Now remember that, in fact, this is also collecting $3.40. So the actual break-even points on a trade like this are going to be, in this neighborhood here. So the green line, and what I got here, 126.5, going to be like that-ish. So I'll get rid of these lines just so that I have so many lines, just so everybody can get a good look. This is the actual break point. And then, to put an even finer point on this, we'll go right to expiration and say, and this is the date for which those breakpoints has been selected. Is that purple, magenta? I'm not sure. But that's what you're basically looking at, right? So it doesn't take really sophisticated even though I used volatility when I was pricing that structure, as I traded it today to establish whether or not I thought the prices were reasonable. That's not all that really factors into this. Most investors are not trading volatility, that is, perpetually hedging or consistently hedging the change in delta that your options positions may have. So, and this is one of the reasons why options trading is not zero sum. It is possible that the market maker who bought this trade is going to make a profit on this trade between now and expiration. They obviously think so. They wouldn't have bought it if they didn't. Because remember, it's not like they had some lit market. It's a negotiated transaction. Hey, I'm looking to do this trade. What level would you? And they said, okay, well, we'll pay the following price, and say, okay, done. Well, the seller requires only that the trade reside between these two levels, between now and this magenta line, which doesn't seem like a bad bet. Seems like a very reasonable one. And if you do those kinds of bets enough, do it a lot, and you're right 80% of the time, even when you're wrong, and even if you're sometimes significantly wrong, you're probably doing okay. Now, the market maker, do they need it to go above the green line, above the call that they bought by more than the premium they paid to make money? Do they need it to go below the put by more than the premium they paid for them to make money? They do not. And the reason they don't is because, due to the theory of replication, what they're going to do is, as their delta goes up, because they're long gamma, so they're going to get longer as the stock rises, they're going to be selling shares. Maybe it gets up only to here, never gets to the break-even point, but they sell a little stock. So now they have this strangle, but they're short stock. And then it goes back down. Maybe it goes back down to here. And because they have long gamma, they have now gotten shorter, and they can buy stock. And back and forth. And all they need to do is squeeze the $3.40 in premium out of all of the trades that they do being long gamma between now and expiration. And so, not zero sum, because the market maker just needs the stock to do this to make money. And the seller only needs the stock to stay below that and above that to make money. Both can be winners. And I think this is a concept in options land that is very difficult sometimes for people to grasp. Okay, so I see we have a couple questions here, and I apologize in advance that I'm going to have another video coming up after this one, and because of that, I'm not going to be able to carry it all the way till a quarter past. That's the reason I'm kind of moving on, and then we can actually also take a look at some other things that are happening, because we're going to have earnings season starting relatively soon. Got the financials, no earnings next week. I think we might have, do we have Delta at the end of next week? So Delta has kind of been the kickoff for earnings seasons now. But on the 14th, we're going to have several of the money center banks, and the only ones that we don't have on the 14th are going to be reporting in a day or two following. Okay, so Eileen, all the analysis you do is so interesting. I asked ChatGPT about identifying options with potential. It recommended N8N APIs and Python scripts to automate the process. I'm definitely going to look into those. So, yeah, I mean, look, one of the things that is definitely happening now is that not only have individual investors you have access to more powerful machines, you have access to all of the information that's available on the internet, which is considerable. You have access to all the information that is provided by the self-directed brokerage platforms, the exchanges, and other interested counterparties, including the OCC and educating investors, which is considerable. You have access to AI, which can help you code. So all of those things are very powerful as well. I would say that as you start, maybe pick a lane with respect to the kinds of trades that you want to do, and start there and come up with some fairly basic analysis. You will notice, for example, I'm sure some of you guys have seen me do the following. I just mentioned the banks are reporting, right? So we'll go to JP Morgan, biggest, arguably the best. They're going to be reporting on the 14th, as I said. So the implied move right now is about 3.41%, and the average earnings-related move is 2.22%. Do you want to sell options or don't you? Here's a question that might be worth asking. Well, the first thing we would probably want to do is say, okay, well, if they're going to be reporting on the 14th, which is 13 days away from now, and I'm going to look out to the July expiration, which is 3 days thereafter, how has the stock behaved around that period of time? So I'm going to say, okay, well, I'm going to have, it's actually really, so we've got, 13 days to go before, and it's going to have 3 days after. So now this column over here, this price change column, and you don't need a Bloomberg to do this. Obviously, it's a lot easier for me to do it this way just because I've done it this way for so long. Now I know essentially what the price movements were over all of these prior earnings. Mine is configured to go back just 11 years, so I've got 11 years worth of earnings. And so I can say, okay, well, I want to analyze this, and I'm going to analyze this in the same way that you might, which is to say, okay, let's just take a look at some option strategies. Now, if the expected move, and here's the way we can see what the expected move is. So it doesn't take any advanced math, nothing fancy. The expected move is basically the price of the straddle that expires on the date that we're looking at, which we've already established is the 17th. So we can go out to July 17th. We can take a look at the price of the straddle. Stock closed 334, so I have to go to 334, 335. Let's call it 335. There we go, 335. This one is 720 by 765. Call it 7.5. This one is 9 by 965. You know what? To keep the math easy, let's just call it 8 and 9, $16. Fair enough. We'll call it a $16. We'll call it a $16. Actually, I'm using the 335, so let's call it 15. So that would, and why am I doing this? Because if I say it's roughly $15, there are strikes down $15. So from 335, that's going to be the 320 puts, and it is going to be the 350 calls, right? So that's approximately the implied move. 350 calls, those look to be about $2.30. 320 puts, those look to be about $3.50, right? Again, I'm just going to round it. We'll call it 2.5, and well, you know what? We'll actually use real prices. So now what I can do is I can say, okay, let's take a look. All right. So I was looking at the 320 puts, and I was looking at the 350 calls. Oops, 350 calls. All right. And we can also just quickly figure out, I'm saying that the stock's about 335, right? So we can quickly figure out without much difficulty what the percentages are. Oops, did that nicely. So these are the percentage moves we're talking about, right? That does not include the premium. So this is just to figure out what the options, what is this, historically, what is that strangle worth? A strangle with a put that's down 4.5% and a call that's up 4.5% in round numbers, what is that worth? And what we can do is we can say, all right, well, the put is going to be worth, a put can be worth no less than 0. Like it expires worthless. That's the worst thing that can happen to a long put position. And the best thing that can happen to somebody who's short. So I'm going to say, okay, the max that this thing is going to be the maximum of either 0 or the strike, which is down 4.5%. So I put in R string 1 minus the downside move. So in this case, the stock went higher, so the put expired worthless. And what's the call worth? Call is going to be worth the maximum of 0 or this number minus S string 1, right? And then we can just take the sum of this and what do we have? We've got the value of that, an equivalent strangle over an equivalent period of time, going back now for 11 years. I can quickly get an average of this number. And I've got 1.9%. 1.9%. And 1.9% of 335 is $6.37. What did we figure out that strangle was worth? So we've got the puts, 340 by 370, 355. These are 2.25 by 2.5, 237.5. So 237.5 plus 355 is 592. So in this particular example, without doing any fancy schmancy volatility analysis, just based on the last 11 years worth of earnings data, and I think that's fairly contextual, right? We can say, at first blush, it would appear that the strangle is not overpriced. But here's something I think we need to do as well, and this is something I would do and do, which... So let's take a look at this now. What? I just got a super chat for $9.99. $10. Thank you very much. So that's the first money we've ever made from this channel. Nobody pays us to do this. Other than Birdie. So thank you for that. So now I've got to answer that question. Let's get on that. That's never happened to me before. Been doing this for years. So, okay. Let's see. Linda has a valid question about the Clarity Act, if it will increase substantial revenue for SoFi based off their stablecoin. So, yeah, you know, oh yeah, let's get to Linda's question first. Where's that? There it is. Do you think it has a chance to pass? You know, probably not a bad idea to take a look at the... Let's see, I wonder if any of the... I mean, I think it's probably better than not, but I still feel like it's a coin toss. I mean, we have... Oops. Apologize for that. Not sure who that is, but that just got muted. So, I think it has a better chance than not to pass, but I don't know that it's a foregone conclusion. And you know, there are some sites that will, you know, offer some odds on this. You know, one of the things we have going on is that I think maybe the chances have probably improved since things might be calming down in the Strait. But, you know, what we have is Congress packs it in a little bit during the summer sometimes. They definitely used to before the advent of air conditioning. So hanging out in Washington, D.C. was probably a little unpleasant in July and August before the advent of air conditioning. And I think one of the things, as the name of the bill implies, this is something that everybody in the space has long desired, right? Which is that uncertainty does not help in the sort of crypto digital asset space. So imagine this. Let's just say that you know everything else. We're going to ignore crypto and digital assets for a second. Let's just assume, for the sake of argument, that we were evaluating a really basic business. And that business was a gas station, right? So you have a gas station, there's a main drag, Route 66, let's say, goes through a town, and you have a gas station in that town. And you decide you want to sell that gas station, and so you're trying to solicit interested buyers for this gas station. And people come and they take a look at your business. You've been in business for 35 years, and it's grown fairly steadily, and your margins on the gasoline you sell are pretty consistent. 20 years ago, you added a convenience store, so now you sell a lot of Diet Coke and chips in addition to gasoline. And this makes up for the fact that you no longer do a lot of automobile service, which was part of your business ages ago, because increasingly people don't need that. Cars have become more reliable. And the buyers of the business become aware of two things. One of the things they become aware of is that there is a chance that Congress is going to say, we're going to outlaw ICE vehicles. We're going to outlaw internal combustion vehicles in 5 years. Everything's going to have to go EV. Well, for a prospective buyer, no matter how good the historical trajectory has looked, this introduces a huge amount of uncertainty. And then, also in Congress, you find out that there may be some highway funding, and that instead of Route 66, there might actually be an interstate freeway put very nearby. Now, these things present material risks. The Clarity Act is actually a benefit for people who want to transact in the space. So this is an opportunity, and having some clarity is definitely going to help matters. For some reason, that same number is calling me back again. I hope that's not urgent. But it called me back in rapid succession. So I'll have to check on that as soon as we're done. So I do think that I do think it's a positive. And I also think that SoFi has done a very nice job, by the way, with their business. And they're growing the top line very nicely. I should add that I have a friend who lives in the same town that I do, who, through their venture capital firm, they actually are shareholders in this business. I think they have a board seat, actually. And so, I think good things about them, but because I have some contact with somebody who's tangentially associated with the business, I would be more likely to, so I should probably just throw that out there. In much the same way that I have often said positive things about United Health, because somebody that I used to work with and think very highly of became a senior executive at the company. And, so we tend, through our associations, sometimes we can have thoughts about things that if we didn't have any association, we wouldn't be predisposed one way or the other. I'm predisposed to like SoFi in the same way that I'm predisposed to like United Health. But yes, I think this is a positive. I think it's a positive in general. I think we do need, for lack of a better word, we do need clarity. And I think it also is going to be good for crypto more generally. This is something, we've talked about it a lot on the channel. I actually wrote a piece about this last night, which is that, I was suggesting to folks who, yesterday, who, are concerned that the damage isn't yet over, that they should not lean on press naked shorts here. That instead, you should maybe just think about, selling some upside call spreads, keeping it relatively tight, and, if the weakness in the space continues, then you can continue to get paid in this way. but that you have very, very defined risk. And here's an interesting thing. I would be very curious to see where this traded today. Oh, you know what? I'm going to pull up options play to do this, because I thought this was really interesting. Yesterday, IBI, was I looking at? No, I was looking at strategy. That's right. So strategy stock, and I was looking out, I think, to the first week of August. And one of the things I noticed was that you could sell a out-of-the-money call spread, a $3 out-of-the-money call spread. And I'm just going to, we'll make it 4 maybe. How about that? Oops, sell, oops, I went that wrong way. Call it 94.98. Let's see what this one's priced at. You could sell an out-of-the-money call spread for very nearly half of the potential value of the spread. In fact, actually, the $3 call spread went on the close yesterday. So this is trading 93.39. Strategy is. And you can sell an August 94.97 call spread for $1.90. So think about the risk-reward relationship in that, right? The most that a $3 call spread can be worth is $3. So if you sell it for $1.90 and it stays below 94, and it's below that now, you could potentially make $1.90. If it goes to infinity, it would be worth $3, and you lose $1.10. So almost regardless of how you feel about it, and the other point I had made was that we've had 4 drawdowns of approximately 80% in the history of Bitcoin. And if you include the next worst one, which was over 70, it was like 74, 75%. So let's call it 5 peak to trough crypto winters that involved a peak to trough drawdown of 75% or more. This one's about 50, a little bit more. So could it get worse? Sure. But do you want to be naked short something like this that was trading up in this neighborhood of 475 and is now trading for $94? I don't know that you really want to do it. By the way, we have a fund that has been leaning against strategy now, and it's we'll take a look at the performance of it, but it's going to have been down today. But the return net of distributions or reinvested has been quite good, right? So had you reinvested, this is selling, effectively we sell call spreads against stocks. In this case, it's selling, we have a synthetic short position, so it's sort of doing it a little bit differently. But think about it, that these are the kinds of returns one might generate if you're getting the direction right on a premium collection strategy. If you allow it to compound, that is to say, take your winnings and deploy those as well, you're looking at 107% that we got in this fund over the course of the last year. And if you had just simply taken the cash distributions, up 66%. So, I think the Clarity Act is going to do what's on the tin. I think that's a positive for everybody. And it's probably long overdue. Okay. Let's see. FinWest. I've got a real-world example. SIBO AUG 320 calls were a nickel at 260, and I went in at 120. Unsure if I'm submitting a fair price or not, so your calculator would be useful. Okay. Well, let's just take a quick peek here. See, really, I'm surprised. I'm kind of surprised that SIBO options, were they that wide? Interesting. And it was just, so FinWest, were those the AUG regulars that you were looking at? So let's take a look here. I'll just assume that they were until I get an update. This super chat thing, I'm really jazzed about that. Now the next question is, where does that money go? Because never having got one, I don't know where that money shows up. It's enough for 2 cups of coffee at Starbucks. I like that. So Jay, the producer, after this, we can both do that. All right. So it was the AUG 320s. So let me get that. I have SIBO 247s. That's pretty far out of the money. Okay. And you were trying to sell those, I assume. You said you were at. We bid for, offer at, little trader lexicon, just to make sure everybody's on the same page here. We'd force everybody to. So let's do this. I'm going to say that you were at $1.20. That's 43.5 vol. That's somewhere between 1 and 2 months. So I'm going to get rid of the historical. One month is 41 and yeah, it's almost 42, and 2 month is 2 month. 2 month. It's out. Look at this. It's almost exactly the same. So let's take a look at the vol surface this way then. Just at the term structure, at the money. At the money first, we'll do there. So July and August, that does not. Oh, I'm actually supposed to be going out 1 month. So here and here. Okay. I see that. So those are about that 1 month separation from here to here. So basically $1.20 would be selling vol right in here. Okay. Your base, and I would say that's question, was the stock right here and did you get filled? So what was your reference on the stock there, FinWest? Because I would say you could sell them a little cheaper than that and still be getting a decent price. And we can examine this a little bit more closely by going into that respective expiration and sort of see what this has to say. So I'll go to August 21. I'm going to ditch prior prices because last week's prices aren't relevant. And let's take a look at this on a strike basis. Oh, that's below 40. Yeah, so that's a bit ambitious. Yeah, so this, no fill. And you know what? I'm going to tell you that doesn't surprise me because of this line right here. So if we were going to, when Jay's calculator does that theoretical smoothing, we're looking at an interpolated surface. For your purposes, because I don't have a volatility that goes out to 320, we have to extrapolate. But I think you can see that this curve is relatively smooth and continuous, right? So that suggests to me it is flattening out. But if I had to guess, I'm going to suppose that the 320s could at almost no chance that they're above 40 vol. Based on this. Okay? So if that is true, then we can put a 40 vol in here, and I will tell you that those options are worth, about 80 cents, 81 cents. So I think if you throw $1 offer out there and you somehow get lifted, I think you got a good fill. I think you got a very good fill. Oh, you know what? So yeah, I'm not surprised you didn't get a fill because that's got to be, yeah, it's a little rich. At least it's a little rich based on that, right? Give me 1 second. I'm getting a message on the Bloomberg here. There we go. That is not the person who was also trying to call me. Such is the life. Very little peace. Maybe I'll have some over the long weekend. Hopefully you guys will too. So, okay. So interestingly enough, producer Jay, using our proprietary system, did a smooth vol surface and calculated the value of those options, and he came up with a price of 79 cents, which is very, very close to the 80 or so that I just came up with. So $1.20 versus 247 and 70 stock is pretty rich. And who knows? there's a chance, it's a slim chance, very slim, but there's a possibility that somebody could be looking at it, and they're looking at all of those offers, and they're saying that, somebody wants to go and buy a call, and they're saying all these calls are offered at $2.40, $2.40. Oh, this one's much cheaper. It's offered at $1.20. It's at half the price of the ones around it. I'm going to go in and I'll buy that. You guys won't do that because you guys are sitting here listening to me and saying that's not how this works. But there are people who do that sort of thing. So there's a chance that you could get lifted. And if you did, that's a great fill. That's a great fill if you can sell those things at $1.20 versus $2.50 stock. That's how we say it. You say, August 320 calls, either ref 250 or versus 250. How are you? This is kind of the way we would communicate. But that would be a very good fill if you got it. Yes, and oh my goodness, it's after 2:00 already. Okay, so let me quickly take a look at these. SoFi, like SoFi, so that's the short version of that. Clarity Act, I think slightly better than 50-50. We get it, but if things get a little bit wild, and we know that a lot of people are going to decamp from DC, that can create problems in getting anything through, as you guys know. Thoughts on NVIDIA 225 SEP. Post next quarterly earnings release, long calls, perhaps sell the 250s against it. So, Bob, first things first, I would absolutely suggest that if you were going to do a trade like that, that you would want to sell some premium, because betting long premium into a catalyst is, for the reasons that we've already illustrated, on its own. Unless you're going to trade your gamma the whole way, and that can be time-consuming and painful and isn't even realistic for many people, I would just offer that you would definitely want to use a call spread to do it. You might also consider just trading some in-the-money call spreads. So if you do that, you have no extrinsic premium. So you can essentially say, let's do this. Let me pull, where's my... There we are. So we'll do NVIDIA again. And, okay. So it looks like technically the options play application is not jazz, and it's been a pretty fits and starts sort of thing. But what you can do to sort of reduce the decay is, and in this case, you can see that options play is doing this by default. It's choosing an in-the-money call. You can actually take it a little bit more like this, and take this down a little bit as well. And essentially, now you're dealing with something that's $12.50 in the money, has a little bit more upside. And what you can see in this circumstance is that you have relatively minimal decay, because the decay on the 185 strike, which is not at the money, is going to be so. And here's the thing to think about, right? So it's 197.5 is current stock price. These are 12.60 in the money. That means you're paying $7 in extrinsic premium and you're collecting $5.30. So your net decay is $1.70, and the forward price is a little bit higher, meaning that there's a cost to carry to owning the stock. So rather than in other words, if you had to go out and buy 100 shares worth of NVIDIA, you're going to end up posting $20,000, right? So you do this trade, and you're posting 1,430. So you get interest on the difference between the 1,430 and the 20,000. That's kind of how we get to this spot. Again, I'm just keeping an eye on my watch here. I think I've got time for another, but that's a way I might consider to play it. Tucker D. Dog, if you ask AI to write a script, never assume it did it right. You must validate every formula, however basic. 100% agree with this. And not because I'm doing any coding, although some of the people around me are, including producer Jay, and I see a lot of the stuff he's doing. In fact, you have seen a lot of it, right? Because the applications I use, sometimes I share them and you see them. So there is, but if you are really familiar with the work you're doing, you will catch things all the time that AI generates. So really, really important to keep an eye on that. The system they had was more like scoring stocks, so a screener in a way, but looking at things like gamma exposure too. Yeah, Gex, I don't know if you're just talking about Gex, which sort of became like all the buzz and people got all excited about Gex. Gex isn't, what's so fascinating about Gex, I think for a lot of people, is it's a little, I like to think about it a little bit like astronomy, right? So you have all of these bodies in space, and you're trying to imagine how something that's navigating through space is going to behave as it approaches various bodies that may have gravitational pull, right? So if you know that there's a huge black hole out there, you know that an object that is going to pass to it, the flight of that object is going to be influenced. So that impact could be large or enormous or virtually infinite for practical purposes, whatever. It could, it could be a black hole. It could be large like the sun, or it could be much smaller like the moon, or much smaller still, something like an asteroid. Gex essentially is a mechanism by which, Tucker D. Dog says, better astronomy than astrology. Yeah, so this is the interesting thing. When it comes to Gex, I kind of think that that's the way I like to think about it. It's like astronomers trying to establish where the gravitational pull of objects that exist out in time and space might influence what's passing by it. And that, I think, is a fascinating element. But I also will say, with respect to astronomy and astrology, I've come to think of economists as astrologers and people in finance as astronomers. They probably won't appreciate that. No offense to any economists in the audience, but I've seen so much just absolute intellectual garbage over the course of the period since the GFC, in particular, from that. I dare not call it an academic discipline. Some of the stuff that's come out is so absurd, but I never would have said such a thing 30 years ago. But such is my distaste lately that I would say they're more astrologists than astronomers. Oh, man. Okay, let's see. I think, all right. Well, that actually, because like I said, it's been an hour, and I normally don't sort of have these fits and starts, but I am actually jumping on another call, and I have to get to that. But I want to make sure that we are consistent as we can be, and do these as much as we can, and I hopefully try to keep it interesting and take it in different directions. And the different direction we got today, Birdie Avile, thank you. $10. Appreciate that. It's a meaningful gesture. How about that? Makes me feel good. So thank you for that. And thank all of you for watching. Like, subscribe, notification bell. Keep the questions and comments coming. If there's a concept or idea that you want to explore in greater detail that I probably need to research a little bit more before we get into it, and maybe some of the things that Linda's asking here, be sure to put those into the comment section too. We do read them, and we try to answer them when we can. So, happy 4th of July. Happy 250th anniversary to this great nation. Enjoy your long weekend, and we will see you here. Thanks for watching.